US Treasury yields rise after stronger retail sales data shows consumers are still spending. Oil falls as Middle East conflict fears ease. Dollar yen slides through 154 for the first time since 1990. And the Aussie and Kiwi dollars are down again. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ Group Chief Economist Richard Yetsenga looks at the lessons Japan's economy could teach others with falling populations.
Japan's not the only place or the only test kitchen anymore for shrinkanomics.
But first, in 5 and 5 with ANZ, US Treasury yields spiked overnight as stronger US sales data drove expectations the world's largest economy will retain momentum amid higher interest rates. Retail sales rose 0.7% in March, compared to the consensus for 0.4%. The 10-year Treasury yield was trading up 13.5 basis points at 4.63% at 4 a.m. Sydney-Melbourne time, while the 2-year, it was up 6 points. The stronger US dollar, as a result, meant the Aussie dollar was trading down 0.3% at 64.45 US cents, while the Kiwi, it was down 0.5% at 59.08 US cents. Oil was down nearly $1 early overnight, with those losses then partially reversing. Brent was down 0.1% around 4 a.m. Sydney-Melbourne time, just over that US $90 a barrel mark. And the S&P 500 was down 1%. ANZ's head of G3 Economics, Brian Martin, says the robust data coming from the US means the conversation around a hard or soft landing might become there being no landing.
And I think it just signals that against the backdrop of solid hiring that we have in the US at the moment, where the 3-month average rise of non-farm payrolls is 275,000, there's more money going into workers' pockets, and that's keeping the economy alive. So it fits with the view of no landing.
Number 2, Brian says market pricing for when the Fed would begin rate cuts was initially pushed out overnight, but settled where it was after last week's CPI.
We've still got just over a 50% chance of rates being cut in July, a decent chance that rates probably will be cut in September, but the fully priced 25 basis point rate cut is November. Now, I think, that's a bit late. I still think July is very much a live meeting. And whilst the numbers have been stronger for March, I do think there are some factors that explain away the strength, particularly in the CPI data. So I will be looking to the PCE to see if that is moderating before making a definitive assessment about whether July is a non-runner.
Number 3, Brent oil fell almost $1 to $89.60 a barrel early in overnight trade as markets breathed a sigh of relief, for now, that the conflict in the Middle East has not widened.
The biggest risks for the oil markets, though, are still that Israel responds to this latest attack by Iran. That could certainly result in the conflict pushing wider across the Middle East. And initially, Iran's oil supply itself would potentially be at risk. But if they decided to then retaliate once again, we could see the oil that moves through the Strait of Hormuz be affected as well.
Number 4, the US dollar continues to strengthen versus the yen, rising through 154 yen to the dollar overnight. There's growing expectation that global factory output is shifting up a gear. Ironically, much better than expected machine orders in Japan help strengthen that view. Here's ANZ's head of FX research, Marja Ben-Zaman.
This is a sign of increased capital spending and investment, plus it's also, again, a leading indicator of manufacturing production.
Number 5, there's been a massive shake-up in the markets for nickel, aluminium and copper, with news over the weekend that the United States and Britain have banned the ownership and trading of these metals coming from Russia. Here's ANZ senior commodity strategist Daniel Hines.
They are in the top 5 producers of those 3 metals globally. So clearly there is a risk that we see another disruption, which, for a market like copper in particular, is coming on the back of other disruptions. So it certainly could cause a fair bit of tightness in some of these metal markets.
But as we've seen with oil, where Russian output was eventually absorbed by India and China, markets might well adjust over the longer run.
Commodity markets are a net zero game, essentially. So you take some away from one area, you fill it in another. So I do think that over time they will be able to adjust, but it does place enormous sort of risks and costs on the Russian commodity sector as well, and that will have to be essentially embedded within commodity prices. So even though we may not see the disruption, clearly the price of producing these goods is just going higher and higher, and that's going to result in prices moving that way as well.
Daniel Hines there. Now, in today's bonus deep dive interview, ANZ Group Chief Economist Richard Yetsenga highlights the quiet achievements of Japan as it emerges from a period of shrinkanomics and the lessons it can teach other countries whose have falling populations.
Japan's been a little bit forgotten, or people have relied on the way they used to think about it was exceptional, particularly from a population perspective. Japan has a shrinking population, its economy really can't grow. But of course, if you just put Japan in context now, we're also talking increasingly about China's population and the reality that is shrinking. And this follows, the experience in Italy and Greece in terms of advanced economies where population has been declining. But in fact, if you look forward over the next couple of decades, not just Greece, Italy, Japan and China, but also economies like Brazil, Thailand, South Korea are all likely to see substantial population declines. That doesn't make things better for Japan, but it does mean Japan doesn't stand out as having to deal with the economic challenges that come with a shrinking population on its own.
And as its population's been shrinking, it has actually been making some quiet achievements. What are the things that people might not have heard about?
Well, a lot of things actually have changed under the surface, and not just under the surface. In top-line terms, nominal GDP really went nowhere for a few decades. Real GDP certainly went nowhere, but nominal GDP all of a sudden has risen 10%. It's not the only thing that matters in the economy, but certainly for a high-debt economy like Japan and like many economies in the world, nominal GDP is the ultimate arbiter, really, of your ability to service that debt. So that 10% rise in nominal GDP is good news. But also under the surface, in the last decade, or at least the decade to the beginning of the pandemic, Japan had the strongest productivity growth next to the US among the 7 major advanced industrial economies. Capacity utilisation in Japan, again like nominal GDP, went nowhere for a long period of time, but actually in the last decade has improved substantially. It's now running around the same levels that we last saw, before the bust in Japan in 1991. Even in the labour market, female participation in the labour market has been rising steadily since 2011. It eclipsed the US quite some time ago. It shifted away from the average of the OECD economies quite some time ago. There are further wins here, no doubt. Japan still doesn't stack up very well when we think about broadly progress in the labour market between the genders, but certainly it's made some important shifts.
And on the inflation front, everyone else is very concerned about inflation, but Japan was one of those where maybe some inflation wasn't such a bad thing.
Well, I think we've been looking for it for decades, haven't we? And what's interesting this cycle, particularly compared with 15 years ago before the global financial crisis, in both periods there was global inflation dynamic, a global inflation pulse. Before the global financial crisis, not a lot of that washed into Japan. Japan didn't seem very fertile ground for attracting inflation or cementing inflation. But this time, of course, inflation has shifted in Japan. Japan's not the only place or the only test kitchen anymore for shrinkanomics.
Richard Yetsenga there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, April the 16th. Catch you tomorrow with a look ahead to New Zealand's CPI data. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.